If you have $10,000 in the bank right now and you want to grow your $10,000 to $100,000, most people think that you have to just keep working to earn more money to grow your 10 grand to $100,000, but that's not the only way that you can grow your money to $100,000. And today I'm going to be going over 5 different ways that you can grow your 10 grand to $100,000. What are these 5 ways? Number 1 is you can save your way to $100,000. You make more money and you save as much as possible to get it to $100,000. Number 2 is you passively invest your way to $100,000. You're working to make money, you invest this money, and then your money is also growing to grow to the $100,000. Number 3 is you're going to invest a piece of this money into your income so you can increase how much money you're making. That way you can get to the $100,000 sooner. Number 4, you can invest your money into an active asset. That way now you're working to grow your money and your money is also working to grow as well. And number 5, you're going to put it all on black. You're going to take the high risk, high potential reward model to grow your money to $100,000. So let me break this down now step by step. That way you understand the different levels of reward and risk associated with each one of these options. And let me start with number 1, saving your way to $100,000. According to the Federal Reserve Bank, the median household income in America right now is just under $71,000, which is actually a little bit lower than where we were back in 2019, which I just thought was a little bit interesting. So if your household is making $71,000 a year and you go out and you say, I'm going to save 10% of my income, which actually is more than what the average American is saving. The average American today is saving just under 5% of their income according to the Federal Reserve Bank. So if you're saving 10% of your income, well, you're already doing more than double what the average American is doing. That means you're putting aside $7,100 a year into your savings. Now, the one nice thing about saving your money today as opposed to 2 years ago is that today you have some high interest savings accounts that are paying 3, 4, even close to 5% in interest on your savings. And yes, these are FDIC insured banks. So if you have $10,000 already put aside and you can put aside an additional $7,100 a year, and let's just say that you can get a 4% interest rate on your savings, which many banks are paying nowadays, that means it's going to take you 10 years to grow your money to $100,000. This is the lowest risk and also the lowest reward option because it's going to take you 10 whole years to do it. But on the low risk side, it's low risk in the sense that you just got to keep working your job, putting money away, and just keep saving the money. The risk now here is, what is the $100,000 actually going to be worth in 10 years because we're still facing high inflation. So 10 years from now, the $100,000 isn't going to have the same buying power as today. This brings me to the second option, which is you passively investing your money to grow it to the $100,000. This means you're going to take the $10,000 that you have in your bank and you're going to put this money to work. Either you're going to use this money as a down payment to buy a rental property or a home, or you're going to use this money and invest it into the markets. And then as you make more money, you're going to keep investing more money, kind of like what you did in the savings number, where let's say you're putting aside 10% of your income every year to keep putting it away into investments. That way you can grow this money and get it to the $100,000 sooner. The number one difference between passively investing your money and saving your money is risk, because when you put your money into the stock market, there's a chance that your money can go down. And because there's a chance your money can go down, you're going to expect a higher reward versus just keeping your money in the bank. Because if you put $1,000 into the bank today, you're going to go there tomorrow and expect $1,000 to be there. If you put $1,000 into the stock market today, you will expect that number to change. Maybe it'll just be $1 or $2 up or down, but you expect that number to change. And so when you have this higher level of risk, that also comes with higher potential reward. So the historical average stock market and real estate return has been somewhere between 7 to 10% a year. And this includes factoring in the recessions and market crashes that we've seen pretty much every decade for the last century. But if you can grow your money by, let's just say, 7% a year, and assuming that we don't see any sort of recession or market crash in the near future, now you put $10,000 into the market. You're putting an additional $7,100 a year into the market, and now you can grow your money by 7% a year. Based off of these numbers, it is going to take you 8 years for your money to grow from $10,000 to $100,000. Now you might hear that and say, but Jaspreet, that's not that much different of a return than me just saving my money. That's going to take me 10 years. This has more risk in only 8 years, and you're right. But the difference between investing your money into the market and savings is, number one, you can see potentially higher returns in the markets. And number two, the real compounding effect is over the long term, because when you get higher returns for a longer period of time, that's when your returns really start to grow and compound and add up even more. If you took this money and you invested it into a rental property, it's a little bit different now because, number one, you're going to be getting rental cash flow which ideally you can reinvest, but you can't just throw that money back into another property because that means you need enough money to use as a down payment or to finance the entire purchase of a new property. So unlike the stock market where you can easily put in $7,100 a year, $500 a month, whatever it is, you can't just put $500 into real estate every single month because you actually have to go out and buy a physical property. So if you passively invested your money, it's going to take you around 8 years to take that $10,000 and grow it to $100,000. The third thing that you can do is you can invest this $10,000 into your income. And this is where things get really fun, because now when you're investing this money into learning new skills and new education, which can allow you to earn more money, now you can see 20% returns, 50% returns, 500% returns. There's really no limit here. And I can only talk to you about my experience here because I've invested in my education in a lot of different ways. I started by investing my money into traditional education because I spent money and time getting my law degree. I am a licensed attorney, but I didn't really get much of a return on that dollar for dollar because I don't practice as an attorney. However, I have invested money into my own, you want to call it self-education or financial education. That has given me much bigger returns. The first time I ever invested in my own, let's call it non-traditional education, was actually I was in college at the time or finishing college. I bought a class or program on wholesaling real estate. And this was after I got my real estate salesperson's license. I went to this seminar about quote unquote real estate investing. Now, I don't consider wholesaling real estate investing. It's a type of real estate flipping where instead of actually buying a property, you're entering into contract to buy a property and then you're going to flip the contract. But I learned about this real estate wholesaling during the seminar. I thought it was really interesting. And then at the end of the seminar, the person who was teaching was pitching a $3,500 program to learn how to wholesale. Now, back then, that was a lot of money for me, but I decided to make the investment partially because it was such a compelling pitch. I invested the $3,500 into the program, and 1 month into it, I made no money, no sales. 2 months into it, I made no money, no sales. 3 months into it, I made no money, no sales. 4 months into it, I made no money, no sales. It wasn't until the 5th month that I actually closed my first deal, and that first deal was $10,000, my commission from the wholesaling that I learned. So, did I make my money back? Yes. Did it take time? Absolutely. Did it take work? Yeah. Was it risky? Oh yeah. Most people who go through any sort of online education program are going to go nowhere with what they learned, either because they give up, they're not willing to put in the work, or maybe they didn't learn anything useful. So you have to understand, how can you use something, how can you learn something that's going to leverage what you're currently doing? That wholesaling real estate education for me was leveraging what I was already doing, because at that time I was investing in real estate. I had gotten my real estate salesperson's license, so I was already working as a real estate agent, but now I had learned a new skill, which is wholesaling real estate, which leveraged what I was doing. We're going to jump back into the show in just a minute, but before we do, here are a few words from our sponsor, M1. If you've been watching my videos, you've probably heard of me talk about passively investing your money in the stock market, where you have a CPA, a consistent, passive, and automatic system where money is automatically invested into the stock market for you. Well, a super easy to use platform that can help you passively invest your money into the stock market is M1. And as a little disclaimer, at the time of me recording this video, M1 is a tool that I use to passively invest my money into my portfolio of ETFs. The way it works is you get to create your pie or your portfolio of ETFs or stocks that you want to invest in, and then you can create a cadence of how often you want to invest into this portfolio of ETFs or stocks. For me, I invest every Wednesday. You can invest every 2 weeks, every month, but once you pick the cadence, you set it and forget it, and M1 is completely free for you to use. Now, of course, investing has risks. Are you guaranteed to make money when you invest? No, of course not. In fact, you will probably lose money at some point, which is why you want to always do your own due diligence and never blindly trust a random guy on YouTube. But you can mitigate some of your risk by investing your money into good assets for the long term, which is why I invest my money into my portfolio of ETFs, whether the market's up and down, because I'm investing for the long term. Now, of course, you want to do your own research, get a financial advisor if you need one, but M1 is a great tool that can allow you to passively invest your money yourself. Minority Mindset is a paid partner with M1, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and create a free account with M1, I got the link to how you can do that down in the description below, where you can go to theminoritymindset.com/M1. That's theminoritymindset.com/the letter M and the number 1. And with that, let's go back to the show. Right now, I run a company called Briefs Media, and we recently hired a consultant to help us with the monetization and just kind of the growth of our newsletter business. And the guy that we brought on has been working in the newsletter space for a long, long time, worked with a lot of different companies. And the first couple of weeks that he worked with us, he just kind of dissected everything that we did. He learned about our sales process. He learned about our newsletter process. He learned about our operations. He learned about everything that we did, just sitting quietly, asking questions. Then he sat down with us and offered us some proposals of things that we can do and little changes that he was sharing that were, not really ground shattering, but very impactful, because little changes that we could do right now could change our revenue monthly by 80%. We could increase our monthly revenue by 80% by doing these few changes, by offering different sales packages to our sponsors, by marketing our sponsorships a completely different way. And that was such a big realization, like, wow, it would have taken us 3 or 4 years, maybe 2 to 3 years to learn how to do this. But because I paid somebody, it was a lot of money, but because I paid somebody to come in and teach us, we just shaved off 2, 3, maybe 4 years of learning off our time, which can allow us to grow quicker, which can allow us to scale quicker. So the question is, can you invest money someplace to learn how to do something quicker, or to learn how to earn more money? That way you can lower the educational process, lower the skills process, and start to make that money sooner. But you also have to understand that this comes with risk. Just because you invest in your education doesn't necessarily mean that it's going to work every single time. For example, when I was building the Minority Mindset blog, this is a number of years ago now, I was thinking, I have this YouTube channel here on Minority Mindset. The problem is this YouTube channel relies on me. And so if I want to build a business, I can't have everything relying on me, because I'm not making videos and I'm not making any money, right? So that was when I had the idea to build the Minority Mindset blog as a place where if somebody's searching on Google for great websites or great stock brokerages, the Minority Mindset blog can show up and give you recommendations. And then the way that these types of blogs make money is that when you get a user of a stock brokerage or real estate firm or whatever it might be, an investment brokerage, that you get a kickback, or you get an affiliate fee, or you get some sort of advertising fee or advertising revenue. So there's different ways that you can get paid from the sponsors or advertisers on your blog. When you get more traffic on your blog, the more money you make. The problem was I didn't have the time to sit there and build a blog because I was busy doing a whole bunch of other things. So what did I do? I hired one of the best consultants and agencies out there to help manage and run our blog. And so I spent probably close to $500,000 over the course of 18 to 24 months, building the teams, paying the consultants, producing the content, having the right softwares, doing everything the right way. I just wasn't putting my time into it because I was busy doing other things. And that $500,000 went to essentially nothing. It was a complete flop. And that was where I decided to shut this down, because it wasn't that we didn't have the right consultants or the right education. It was just we needed more direction to be innovative, to do something that would actually benefit me, because this was like building something in a whole different universe. I had no experience with building a blog, and that didn't benefit really anything that I was doing. It was different. And so now the question is, if you want to increase your income, that way you want to invest more money, you want to save more money, you want to put more money aside, or you want to have a bigger equity in your business value, the question is, how can you invest your money in a way that's going to allow you to learn a skill that's going to allow you to earn more income? And when you earn more income, either that's more money that you can save to get you to the $100,000, either it's more money that you can invest to get you to the $100,000, or it's more valuation for your business, because if your business is making bigger profits, your business becomes more valuable. If your business makes $100,000 a year in profit and is valued at a 10 times multiple, a $100,000 profit is worth $1 million. But if you can grow your business to $500,000 of profit, now your business is worth $5 million. So the value of your income now is, how can you increase the income to increase your path to whatever wealth it is, whether it's savings, whether it's your investments, or whether it's the valuation of your business. But you have to invest your money in a way that's going to already improve or teach you a new skill set. Now, if you're saying, but I don't have any sort of skill set, the simple place where you can start is just learning how to sell. Now, I'm not going to lie, I am not the best salesperson. I think I'm a much better marketer than a salesperson, but being able to sell is a very valuable skill, and that's a skill that can transfer across multiple different industries, multiple different companies. So if you don't know where to start with learning how to sell. I started that with my real estate salesperson's license. I purchased a bunch of audiobooks on selling. I took a bunch of classes on selling. I took seminars on selling. I learned how to sell. It just wasn't something that I was very good at. But that's a good place for anybody to start, is about just learning how to sell, because if you learn how to sell, that is a very transferable skill. This brings me to the fourth way that you can grow your money, which is by putting your money into an active asset. Now, if you are an investor and you want to stay up to date on what's happening in the top finance and business news, an easy way to do that is to join something like Market Briefs. Market Briefs is my free financial newsletter that I created to help you stay up to date on what's happening in the economy, the stock market, the housing market, the global economy, and the crypto market. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I'll also put the link for you down in the description below. Putting your money into an active asset means now you're going to invest your money and your time. So when you invest your money into the stock market, this is more of a passive investment because you're just investing your money. If you invested your money into the Amazon stock, you're not telling Amazon what to do, and you're not working at Amazon. But now if you are putting your money into an active investment, like buying a small business, now you're putting your money into it and you're going to be working to grow it as well. Now there's a lot of different ways that you can do this, and you can also work to build your own business. But let me start by talking about buying other businesses, because there's a whole range of different things that you can do. Now, for people that are in the Indian culture, this means buying a gas station, buying a convenience store, buying a liquor store, because now what you're doing is you're buying this type of asset. You're buying this active asset. You can use your money as a down payment to buy this small business. Now, you can work in the business or work to manage the business or work to grow the business, but the value here is you own the value of the asset, and you're also getting an income and hopefully make a profit as well. Now, some, I understand, convenience stores, liquor stores, gas stations make no profit, and you're just literally buying your own job. But in an ideal scenario, the way that it works is you're going to put some money into this thing. You're going to buy this asset, and now maybe you work there, maybe you don't, but you're going into this thing and you run this business. Convenience store, liquor store, gas station. Now, when you run it, the people that work there, whether it's you or somebody else, is getting a salary. And after paying for all the expenses over the year, there is a profit. Now, if you're working in this business or on this business, your goal is to grow the profit. Because now when you buy it, let's assume that it has a 30% profit margin. So you bought this $100,000 business. You put $10,000 down that you had. You bought this $100,000 business. It has a 30% profit margin, meaning you're getting a $30,000 profit at the end of the year after paying for all the expenses. This is hypothetical numbers, I know. But now you come in and you can take it from a $30,000 profit at the end of the year to $60,000. Now what does that do? Now you own the business. Maybe you get a salary, maybe you don't, but the profit at the end of the year goes from $30,000 to $60,000. That means two things. Number one, that's more money for you to save to get you to $100,000. It's more money for you to invest into the stock market or real estate market to get you to $100,000. It's more money for you to invest into your income, learning skills to get you to the $100,000. And number four, it's also going to increase the value of your equity in the business, because if that $30,000 profit in the business was worth a $100,000 business, now a $60,000 profit means that this business should, in theory, be worth $200,000. That's the first way that you can run an active business. The other way is you can go down the franchise model, looking at buying things like a UPS store or buying a Domino's pizza. Now, I've never got into franchises, so I don't have any experience myself, but this is something that I know is very popular, where you take some of the money that you have, you're working to buy the business. The main thing is you don't want to just go out and buy yourself a job. You want to work to grow the business, because now if you can grow the profit, you're going to grow the valuation of the business, and that means your job should not be to just work in the business because you can hire somebody else to do that. Your job should be to grow the business presence. That's where the real money is, because you can hire somebody to take the orders. You can hire somebody to run the cash register. You can hire somebody to do the customer service. And if you're just sitting there working there, that way you can save $17 an hour, you are really looking at the short-term goals as opposed to the long-term goals. Yes, it's the cost to hire another employee, but if you can work to grow the business, that means you can have a second business and a third business and a fourth business. So that's one way that you can run an active business. Another way that you can run an active business would be now for you to build your own business. Now, this could be an infinite number of things. I know on the internet, people love talking about flipping real estate. That could potentially be an active business. Is it difficult? Yeah. Is it risky? Heck yeah. But it has made some people a lot of money. Other active businesses could be some sort of digital company that you can create. You can get into content. You can get into selling services. If you have some sort of skill, if you're an accountant, if you are really good at digital design, you're good at graphic design, if you're a good copywriter, these are all skills that you can market. Even if you have a professional skill, if you are an attorney, now you can work on building some other sort of legal practice. If you have an engineering background, you can build some other business out of that. What type of business can you create now where you can take the money that you have and you're going to put it into the business to do two things? Number one, increase the profit, and then number two, increase the valuation of the business. Because when you invest in the Amazon company, you're letting the CEO of Amazon increase the profit and increase the valuation. Now, when it's your own, now you're working to increase the profit and increase the valuation. So now you have more control. Like here at Briefs Media, one of the things that I do is when we take a profit, a portion of it goes back into advertising and marketing. What does that do? Well, that allows us to grow our user base. What does that do? More user base allows us to grow a profit. What does that do? That allows us to increase the valuation of the company and do more things with the profit that we have. So the question now is, how can you now work to use your money? Now, the difficult part here, or the tough part, is that this is more risky. Because if I invest my money into Amazon, I get the security of knowing that Amazon is a major company. Or if I invest my money into an ETF in the stock market or a fund that gives me exposure to the biggest 500 companies in the stock market, I have security of knowing that I have 500 major US companies that are supporting the value of my investment. But when I put money back into my own company, if I take $100,000 and I put it back into Briefs Media for advertising, or $10,000 and I put it in for advertising, I have no clue where that money is going to go. I can work to grow it, but it's a higher risk because, well, my company can go bankrupt. If we cannot continue to get sales, if we cannot continue to drive revenue, the company will go bankrupt and everything that I invest will go down to zero. But I believe in myself. I believe in my team. I believe in the products that we're putting out. I believe in the value that we have, which is why I'm willing to do that. And so you now have to understand what is the risk and what is the best potential reward for you, because this has the potential, if you have your own business, this has the potential to give you the highest reward. You could take your $10,000, take it to $100,000 in 3 years or less. Is it guaranteed? No, absolutely not. It can take you years to learn how to do it, but once you learn how to do it, you can do it every 3 years, every 2 years, every 1 year, because now you learn how to grow and scale what it is that you're doing. And so the key here now is you're putting your money to work, but you're also putting your time to work to also grow that money. But this one isn't for everybody, and you have to understand the level of risk that's associated with that, which brings me to number 5, which is taking the high risk, high reward game. This one isn't something that I have experience with. I hate gambling. I went to Vegas, Las Vegas, with my wife, which is actually, we had a great time. I don't gamble, I don't drink, I don't smoke, but we had an amazing time in Las Vegas, which I think everyone laughs at us when we say that, because it's just so much fun to walk down the strip, see the lights, especially, I'm from the East Coast or the Midwest, but we have East Coast times. When I went there, you get to see all the lights. I got to wake up very early. So I'm walking around the streets at 5 a.m. when nobody's out there. You see the lights, and it's just so cool. And there's so many places that you can go. The shows are amazing. The shows are amazing, and the food is great. So I had a great time in Las Vegas. But when most people think of Las Vegas, they're thinking, how can I turn my $10,000 into $100,000 this weekend? And most of the time, 99.9% of the time, that $10,000 is going to pay rent for the casino. In fact, why do you think the casinos are so beautiful and so nice and so grand? Well, the money that you're gambling is going to fund the casino's mortgage, the casino's rent, and all the beautiful things that you see. But there's going to be that small, teeny, tiny percentage of people that will win, and that's what's going to drive everybody else to want to try the way to put it on black and try to win. Now, this doesn't mean you have to necessarily gamble your money, but there's a lot of other ways to do this. We all have that one friend who's always looking for that get-rich-quick way. They don't say it's called a get-rich-quick scheme, but they're always looking for that get-rich-quick strategy. Maybe it's the next hot meme stock. You read something on Reddit, and they're telling everybody about how much money they put into Reddit, and they're ready to see this thing soar. It starts to go up, and then it goes down, and they lose 70% of their investment. Maybe it's the next hot cryptocurrency. They see some cool cryptocurrency options, and then they find these unheard of cryptocurrency trends that are happening in like this weird blog on the internet, and then they start putting their money into this cryptocurrency, and then they see it soar and they tell everybody else to buy it, and that's when the cryptocurrency crashes, and then they lose all of their money there. We all know somebody that does this. This can make you a ton of money, but it can lose you all of your money just as fast. This isn't something for me, but I'm going to give you a piece of caution here. If this is you, you're always looking for that way to get rich quick. Let me just tell you something. Everybody wants to get rich quick. I mean, it's not attractive to get rich slowly, but the reality is some people will. A very, 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 very small percentage of people will. Is it going to be you? Probably not. Now, this is where you can play the odds. If it's probably not going to be you, statistically, is it worth your time, effort, energy, and brain power to keep trying that, or to go to something that has potentially higher returns, but just takes a little bit more time? And that's a decision that you're going to have to make. Because if you just keep gambling your money, doing all these hypey things, well, there's a reason why you haven't gotten there yet. And this is where now, if you can follow the path of people that have actually become successful, they haven't gotten there because they gambled their money there. They didn't go there because they found the next get-rich-quick scheme. They got there because they consistently did something. They consistently invested their money slowly over long periods of time. They consistently worked to grow their income and put some of that money away, whether it's invested or savings. They consistently worked to build their business, even when things got hard, and they consistently made pivots that way they could grow the value and the income that's coming out of their business. Those have been proven. Some are riskier than others, but they've been proven to make more money, and this is where you got to decide what is the right option for you, and are you willing to actually do what it takes to become wealthy? Because if you keep going down the get-rich-quick schemes, well, those are the same people that get so salty and have such a negative taste towards the entire economic system, towards successful business people, towards successful investors, because they keep getting burned. But maybe the reason why you keep getting burned is because you keep going down all the wrong routes. And I know that's the attractive part. Vegas has all those lights because they want people to come and look at the lights. That's the attractive part. But real wealth building is done in silence. Real wealth building is done kind of in stealth mode, where you're working where nobody else is and you're working in silence. That's where real wealth is built. Now, when it comes to actually putting your money to work, there are ways that you can get better returns. And the way that you can get better returns is, number one, you invest in your financial education, but also number two, look for where the opportunities are, because where the opportunities are is always changing. Like in the 2020 pandemic, when stocks crashed, that was a huge opportunity. In the 2008 crash, when real estate prices crashed, that was a huge opportunity. In the 2000 dot-com bubble burst, that was a huge opportunity to go out and buy some internet companies like Amazon, which had fallen by more than 90%. So the question is, how do you find the opportunities? And the way that you do that is just by paying attention to what's happening in the markets around you and studying the trends. Because if something is not going to die, but its valuation is falling, that creates opportunity, and this requires you now to understand what's happening and understand what's going on with consumers, understand what banks are doing, understand what's going on in different parts of the economy. That way you can make better decisions with your money. So let's take a look at what banks have been doing. In just the past few weeks, we've seen a number of different banks come out and report the latest earnings, the latest profit figures, and then their predictions of where the economy is going. And the common trend amongst most big banks, not all of them, but most big banks, is that profits have been soaring because, let me just read it to you, because they've been seeing increases in lending and credit card transactions. But it's not just the fact that they've been seeing more lending and more borrowing happen, but the fact that this borrowings happen at significantly higher interest rates. Because now when you swipe money on your credit card that you don't have, the interest rate on your credit card is significantly higher. When you go out and you borrow $500,000 from a mortgage, your interest rate is a lot higher. That means the bank is making more money in interest, which can help drive up profits so long as people are borrowing money. And right now, people are still borrowing money. Now, all of this so far is the obvious part, but the part that's even more interesting isn't just the profits that banks are making right now, but rather what banks are predicting about the economy coming in the future, because that's been signaling some interesting pressures ahead in our economy. And the way that I want to do that is by going directly to the source, meaning directly to the banks and seeing what the banks have said instead of listening to the media's coverage or what the banks said. That way we can get a better idea of the bank's predictions of what's coming in the economy. And I want to take a look at JP Morgan Chase Bank's press release that they put out when they release their earnings statement. Now, just so you know, if you want to read the press release for yourself, I've also linked it for you down in the description. And Jamie Dimon is the CEO of JP Morgan Chase Bank. And in the press release by JP Morgan Chase Bank, Jamie Dimon put out his own statement about what he feels is going on in the company and what might be coming in the economy ahead. So let's take a look at that. He starts off by saying that we have seen another quarter of strong results with huge profits and growth across the entire business. But then a little bit later in his statement, you start to see a few words of caution about what might be coming next, because the company is doing great today, but he's also taking it with a grain of salt. The United States economy continues to be resilient. Consumer balance sheets remain healthy, and consumers are spending, albeit a little bit more slowly. Labor markets have softened somewhat, but the job market remains strong. That being said, there are still some salient risks in the immediate view, many of which I have written about in the past year. The reason why it's interesting is because he says that consumers are still spending, but it's slowing down. The job market is strong, but is softening a little bit. And then he says that there are risks in the economy that he's been talking about. Now, what are these risks that he's been talking about? Well, consumer spending. See, the interesting thing about consumer spending is that consumer spending is good for the economy, especially in the short term, but it's bad for the consumer. Just take a look at what Jamie Dimon said when an analyst asked him about that. The consumer is in good shape, says Jamie Dimon. They're spending down their excess cash. See, our economy is based on spending. The more money you spend, the richer somebody else gets, period. If you don't spend your money, that's not good for the economy. It might be good for you because now you can save your money, you can pay down your debts, you can start investing your money, but it's not so good for the growth of the economy because that means now Chipotle, Sweetgreen, Lululemon, Apple are not making money because you refuse to spend your money or because you have no more money to spend. What we've been seeing happen recently is that savings balances have been falling because people are digging into their savings to fund their regular expenses. And in addition to that, credit card balances have been rising because, again, people are using the credit card to fund their daily expenses. So the economy is booming because people are spending. But people aren't just spending their incomes, they're having to spend their savings and they're having to spend their credit cards. Because now when you spend and the economy is booming based off of people's incomes, no big deal. But when people have to go beyond their means in order to spend, and that's why the economy is booming, well, there's a lifespan with that. Because there's only so much debt that people can go into. And there's only so deep that people can go into their savings before they run out. And that's kind of the double-edged sword of consumer spending, where, yeah, consumer is strong. People are spending like crazy. They're spending down their savings. But then what happens when the savings get spent? And that's the double-edged sword that Jamie Dimon is saying that there's still some risks ahead. Consumers are slowly using up their cash buffers. Core inflation has been stubbornly high, increasing the risk that interest rates can go up higher and stay higher for longer. Quantitative tightening of this scale has never occurred. Fiscal deficits are large. And then you have the war in Ukraine that's still going on. There's a lot to unpack with that one. I already talked about now how consumer spending is going up because people are digging into their savings, but there's only so much that people can dig into their savings. The second thing that he talks about is inflation and interest rates and how they go hand in hand. Number one, that core inflation is still so high, and that's the reason why we could be seeing higher interest rates in the future. Now, the interesting thing about this is if you've been paying attention to what's been going on in the financial media, or if you've been reading this in market briefs, that CPI has fallen from its highs of 9-point-some% all the way down to 3%. This has been the headline of inflation for the past little while, that inflation is coming down. But what's interesting is that Jamie Dimon said core inflation is still so high. Core inflation is a different measure of inflation, and core inflation is what the Federal Reserve Bank looks at when they make the decision of what they want to do with interest rates. And now if we take a look at core inflation has fallen all the way down to 4.8% from its high of 6.5%. So core inflation has fallen, but it hasn't fallen as drastically as CPI. Core inflation is what Jamie Dimon is talking about. Core inflation is what the Federal Reserve Bank is talking about. Core inflation is much more stubborn and more difficult to bring down. And this is where Jamie Dimon is saying that we could still see higher interest rates. Then, to couple that, Jamie Dimon talks about the effect of all this quantitative tightening that we haven't seen this rapidly ever. What is quantitative tightening? It's the opposite of quantitative easing. What is quantitative easing? Quantitative easing is money printing. That's what we saw happen in 2020 and 2021. The Fed opened up the money printer and they cut interest rates to stimulate the economy. Well, the side effect of all the quantitative easing was the inflation that we have been seeing and are still seeing. Now, to combat the inflation, the Federal Reserve Bank has to do quantitative tightening. What's quantitative tightening? Well, now raising interest rates, and instead of printing money and putting it into the economy, they're trying to pull money out of the economy by selling off some of their balance sheet. Now, these higher interest rates have an effect. And Jamie Dimon is saying that we haven't seen the full effect of this quantitative tightening. We haven't seen the full effect of the higher interest rates, while interest rates could potentially even go higher from here. And then he briefly talks about the national deficit. The national deficit means the government makes an X amount of dollars in tax revenue, and then they spend a whole bunch more than that because they have higher expenses. Well, the national debt here in the United States just passed $32 trillion. There's a cost to this, and the cost is, well, the government has to pay this money back plus interest. Well, the difference between now and a couple of years ago is that a couple of years ago, interest rates were so low. And so now when the government has to pay this money back, because yes, the government has to pay that money back plus interest, now the government's payments are rising. They're rising not just because the debt levels are rising, but because interest rates also adjust. The government doesn't have a 30-year fixed rate mortgage. Their interest rates also readjust. And so now in the coming months and years, as more and more of the national debt readjusts, the interest payments for the government will also rise. Now, the interesting thing is, how does the government get their money? Well, they get their money from you and me and everybody else, taxpayers, through tax dollars. So that means more and more tax dollars are going to have to be used to pay down the debt instead of being used to build bridges and hire firefighters and police officers and teachers and actually improve the investments into the country. That's a concern, because that means, well, how is the government going to continue funding all their operations? They might have to print more money. That could cause more economic issues because, well, more money printing, more inflation at a time when there already is high inflation. You can start to see the concerns with that. And then Jamie Dimon tops it off by talking about the war in Ukraine and the potential geopolitical issues that are going on with that. Now, I'm not a geopolitical expert, but the war in Ukraine, if that expands, can cause more issues. Not to mention the fact that even if it doesn't expand, the war in Ukraine is a money pit financially for the United States. Now, of course, there's devastating life losses, which are unquantifiable, but from the United States perspective, the United States is spending billions and billions of dollars helping fund Ukraine. There's a cost to that. There's a cost to taxpayers for that. So all these things coupled together are the red flags that Jamie Dimon is saying is that, yeah, consumers are spending money. That's causing the economy to boom, and that's causing our profits to boom because we're getting more interest payments. However, the spending is slowing down. Why is spending slowing down? Because the savings are dwindling. Credit card debts are reaching their peaks. They haven't hit there yet. But if that were to happen, that could cause a real slowdown in the economy. And that's the concerns that Jamie Dimon is talking about. So what does all this mean for you? Well, number one, this is why you need to get financially educated. This is why you need to get prepared. And then number three, this is why you should be paying attention to what's happening. That way you can understand what's happening instead of getting blindsided. And that's why I created Market Briefs as a free resource to help you stay up to date on what's happening when it's happening. But again, I'm going to go back to some of the things that I've said before, which is you have to be able to look at where the opportunity is. And BlackRock has been talking recently about where they're looking for new opportunities. BlackRock says that they are seeing a once-in-a-generation opportunity, and it starts with the higher interest rates that we've been seeing. The higher interest rates are enticing more and more investors to move their money into money market funds, and this is happening faster than we've ever seen before. Well, what's interesting is I was reviewing BlackRock's latest earnings reports, and one of the things that they talked about was this huge growth in money market balances, and they said, quote, "We're calling this a once-in-a-generation opportunity." That was when I started digging a little bit deeper, and I learned that BlackRock even created an entire report about how this money market blow-up is creating a generational investment opportunity. So I've already spent the time reading through and analyzing the report. I'm going to break it down for you here, but if you want to read the report for yourself, I'll also link it for you down in the description. But to really lay the foundation, you have to start by understanding what is a money market. because there are money market accounts, like what your banks offer, and then there are money market funds. If you go to your bank to open up an account, they're going to give you the option to open up a checking account, a savings account, and maybe even a money market account, which is kind of like a glorified bank account where now you have the option to get higher interest rates than a savings account, but you also have the ability to write some checks out of your money market account, plus it's FDIC insured. But these money market accounts is not what BlackRock is referring to. They're talking about money market funds. Money market funds aren't offered by banks when you go to open up a bank account. They are a type of mutual fund that's offered by mutual fund companies like Fidelity and Vanguard, and these money market funds are not investing in stocks. Rather, they are investing in debt, like loaning money to the United States government. Now, the difference here is that these money market funds are not FDIC insured, but they give investors the ability to earn some interest on their savings, because now instead of keeping your money in the bank in a savings account, you can put your money into this money market fund and get some interest and hopefully keep your money safe. That's the key. And what BlackRock has been pointing out is that over the last number of months, we've been seeing a massive flood of money into these money market funds as investors are looking for a safer way to finally get some interest on their savings. Now that we've established that, let's jump into the BlackRock report. Now, if we jump into BlackRock's report, the report starts by saying the new market regime has unlocked investment opportunities in fixed income and credit not seen in a decade. What does that mean? People have the ability to finally get a return on their cash. But the question is, why has this been happening? In BlackRock's words, the Fed's hiking activity has raised all boats. What that means is that over the last 18 or so months, when the Federal Reserve Bank has now started raising interest rates, these higher interest rates mean two things. Number one, when you go to borrow money to get a mortgage, it's going to cost you more money because the banks have to pay higher interest rates to borrow money themselves. See, the Federal Reserve Bank doesn't set mortgage rates. They set the federal funds rate. You can think of this like the wholesale price that banks have to pay to borrow money at. And now because banks have to pay more money to borrow money, they have to charge you higher rates to borrow money from the bank. So you borrow money at the retail rate, banks borrow money at the wholesale rate. That's happening on the consumer side. But it also creates an effect when you save money. Like if you go and save your money in the bank, banks now have the ability to pay you higher interest rates because interest rates have gone up. Banks are paying or getting higher interest rates, higher margins when they lend money out. And so they pay you a little bit higher interest rates when you save your money in the bank. And this is where now investors who have a lot of cash can look for ways to get a yield or a return or some interest on their savings. Now, this could be you putting your money into a CD. This could be putting your money into a high interest savings account, or this could be you putting your money into something like a money market fund, which has the ability for somebody to put in more money, and you can also get potentially higher interest rates. And hopefully, as long as the economy is good, your money will be safe as well. What BlackRock says is that now investors can reach their investment return target without having to reach aggressively into higher risk products. Right now, in today's economy, if you're sitting on cash, there are ways for you to get 4 to 5% in interest on your cash, whether it's a high interest savings account or whether it's a money market fund. And before, if you wanted to get 4 to 5% of a return on your money, the only way you could do that was not by putting your money in the bank. It was not by putting your money into a CD. You would have to put your money into the stock market or the real estate market or into a business idea, something that was riskier than just keeping your money in cash. Because when you keep your money in a savings account, that's less risk and generally less reward. But now because of the higher interest rates, you can get higher returns in a high interest savings account or a money market fund. Now, the reason why BlackRock says this is important is because bonds should once again offer hedge and diversifying potential in portfolios. So now we know that interest rates are higher because of the Federal Reserve Bank. People can get a return on their cash, but what does the growing amount of money in money market funds have to do with BlackRock, and what are they actually doing about it? Well, let me actually just read you what BlackRock said from their earnings call. The trillions currently in money market funds are, quote, ready when people feel the rates have peaked to flood the fixed income market, and we need to position ourselves to capture that. So the Federal Reserve Bank has been raising interest rates to fight off inflation. This higher interest rates have given investors the ability to finally get a return on their cash by putting their money into places like money market funds. But this is where BlackRock is saying that we could be reaching a peak in higher interest rates in the future. because inflation has been falling. So if the Federal Reserve Bank stops raising interest rates, that means the interest rates that you get on your high interest savings account or your money market funds could be peaking as well. And when investors take a look at their money market funds peaking in interest rates, because over the last 6 to 12 months, the interest rate that you've been getting on your high interest savings account, on your money market funds have been rising because the Federal Reserve Bank has been raising interest rates. Once that interest rate peaks, or when investors are confident that the rate has peaked or is close to peaking, then they might start looking for alternatives. And right now, we have more money than ever sitting in money market funds, trillions and trillions of dollars. And that's where BlackRock is saying investors are going to want to pull money out of their money market funds and deploy it somewhere else. Maybe they'll put it into stocks, maybe they'll put it into real estate, or maybe they'll put it into fixed income assets. That's what BlackRock is predicting, because investors have become so accustomed to this consistent return. Now, to make sure we're on the same page, what are fixed income assets? These are generally things like bonds, where you're investing your money into a loan, you're loaning your money out, and then you get a return for lending your money out. And this is where, on BlackRock's position, one of the things that they're doing is they're positioning their bond offerings to capitalize on when investors want to move money out of their money market accounts. But what they're saying is that there's all this money essentially sitting on the sidelines. And the reason why it's sitting on the sidelines is because investors are saying, you know what, I'm looking at the investment opportunities out there. I'm looking in the stock market and everything's overvalued. I'm looking into the real estate market, everything's overvalued. And investors have stockpiled all this cash, trillions of dollars. And so now they're just looking for any yield, any return. And where are they getting this return right now? Well, it's these money market funds. It's a place where they can get some sort of interest on their money. The principal on the money is not really doing anything, but they're getting some interest on their money, which is the value now for the investor. Well, when the returns on these money market funds start to peak out, because now the Federal Reserve Bank is no longer raising interest rates, that's when investors are going to say, okay, now what are our options? Because the money market funds are kind of tapped out. We don't want to just have this money growing at a certain rate and not capitalize on new potential opportunities. This is where BlackRock is saying, well, new opportunities are going to arise with things like lending money. Because now with the higher interest rates, investors will have the ability to get higher returns by lending their money. And potentially, you could see a flood of money moving into places like the stock market, assuming that investors feel they can get a good return in the market. But the interesting thing here is, on an economic level, there's a lot of money still sitting on the sidelines. And anytime you start to see an economic downturn, that money on the sidelines has already dissipated. There was a lot of money created in 2020 and 2021. That money is still there. It's in different places, but that money still is there, and some of that money needs to be dissipated. So that could create booms in different parts of the markets. And this is what BlackRock is talking about. With all this money sitting in money market funds, this money market fund has blown up. And now when interest rates stop rising, that's when investors might start pulling their money out of money market funds. And because of the amount of money in market funds right now, that could be a lot of money that comes out. So there's three things that BlackRock talks about that they are doing. Number one is that they're optimizing liquidity, meaning they want to have easy access to their money. That means working on investing their money into things like short-term bonds as opposed to tying up their money for 30 years. The second thing is rethinking core allocations. That means one of the things that they're looking for is the lowest risk, or potentially risk-free, what they call risk-free investment options. And the third thing is considering non-benchmark exposures as diversifiers. That means for them, diversifying their money across different sectors and different assets. So now, what does this mean for you? Well, number one, if you have cash sitting on the sideline, get some sort of return on that money. Don't just keep that in an account that's getting you 0.01%. There's a lot of ways to do that. You can look at high interest savings accounts, which are FDIC insured. You could potentially look at other types of accounts that are giving you interest. But this is where BlackRock is saying that money market funds have grown significantly. They are not FDIC insured, but they believe that some of this money is going to start leaving money market funds once the Fed stops raising interest rates. If that were to happen, we could see a big movement of capital, a big movement of money, because we're talking about trillions of dollars that is sitting in money market funds that could go into other asset classes. That could be bonds, that could be stocks, that could be real estate. Well, anytime money moves into other asset classes, the value of that asset class goes up. So this is where BlackRock is predicting that a big chunk of this money is going to go into bonds. And so they're positioning themselves through their own types of short-term bonds. That way they can capitalize on that move. Now, you do not want to blindly follow or copy or listen to what anybody does, especially a random guy on YouTube. But my goal with this is to help you to understand what's happening from different positions and different perspectives. That way you can be a more educated investor, understand what different people's perceptions are. That way you can make the best educated decisions for yourself. That means number one, you need to work on your own financial education. Number two, you need to work on being prepared for yourself, getting your money right. And then number three, staying up to date on what's happening. That's one of the reasons why I created Market Briefs, my free financial newsletter. That way you can stay up to date on what's happening when it's happening. That way now you can make the best decisions for you, your family, and your community. They know how to come up with an investment strategy. They know how to deploy their money. They know how to sell their investments. Well, they have a much higher chance. It's not guaranteed. You're never guaranteed to make money when you invest, but you have a much higher chance of making money. So this is where now you got to understand the risk versus reward ratio and understand what is going to be your investing strategy to get the best returns.